have money in the stock market right now, whether it is in individual tech stocks, index funds, or a retirement account, you need to watch this video before the end of the week. Three distinct macroeconomic forces are colliding at the exact same time. Most everyday investors have absolutely no idea that these shifts are happening under the hood. By the end of this video, you will understand exactly how this engine operates, why it matters to your personal net worth, and the one simple strategy that has quietly built massive wealth for ordinary people every single time the market faced this exact setup. Let us dive straight in. Level 1 is the I dream hitting a wall. Let us start with a fundamental rule of behavioral finance. The stock market does not move up and down based on current physical reality. It runs entirely on what investors believe reality will look like far into the future. For the past 18 months, a single narrative was driving nearly every major technology stock higher. It was the firm belief that artificial intelligence spending would grow exponentially forever, with absolutely no ceiling. Hardware giants like Nvidia were being valued by Wall Street as if they would experience unhindered acceleration for the next decade straight. For a long time, the price action made that narrative feel unstoppable. But eventually, forward expectations have to square up with real-world timelines. We just witnessed the first major structural warning sign from the microchip sector. Broadcom, which is one of the largest foundational chip designers on the planet, reported its quarterly earnings results. The real numbers were actually fantastic. Their AI semiconductor revenue grew by a staggering 143% year-over-year, reaching nearly $11 billion for a single quarter. That is not a company in trouble. That is a business operating at absolute peak capacity. But a major problem emerged because the stock had already been priced for absolute perfection. Management merely reiterated their full-year targets instead of aggressively lifting their long-term projections. Because Wall Street expected an endless series of upward revisions, the market treated an excellent report like a massive disappointment. The tech-heavy Nasdaq index faced a sharp, localized sell-off immediately following the news. This reaction exposes exactly how fragile the current market rally truly is. When growth expectations outrun physical capacity, the slightest pause causes trillions of dollars in paper value to instantly shake. This expectations reset is now moving directly into the physical infrastructure of the economy. Level 2 is the data center slowdown. To see where artificial intelligence actually lives in the physical world, you have to look at industrial data centers. These are massive, warehouse-sized structures, packed wall-to-wall with servers, liquid cooling loops, and high-performance networking gear. Every single automated workflow, large language model query, and cloud application runs inside these specialized hubs. Building them requires hundreds of millions of dollars, vast plots of land, and massive, uninterrupted quantities of electricity. 4 major tech giants announced plans to channel a historic $650 billion into infrastructure this year alone. But a quiet bottleneck has completely stalled the timeline. According to recent market data, nearly half of all planned data center construction projects slated for completion this year across the United States have officially been delayed or canceled outright. Satellite imagery and industry audits confirm that tech giants, including Microsoft, have been forced to defer gigawatts of planned infrastructure capacity. The honest reason for this sudden deceleration is not a lack of cash. The real-world physical grid simply cannot deliver the power required to run these facilities. High-voltage transformers are backordered for years. Utility companies are struggling to allocate electricity, and local communities are legally blocking the builds. To be absolutely clear, Big Tech has not stopped investing in the future of AI technology. The spending trajectory remains highly aggressive, but the actual pace of the physical build-out is being compressed by real-world constraints. For the stock market, the exact speed of growth matters just as much as the growth itself. When forward revenue models are forced to stretch across longer timelines, trillion-dollar valuations start to face severe pressure. Now let us look at the exact mathematical reason why these specific stocks are so incredibly vulnerable to a shift in speed. Level 3 is why tech stocks are so vulnerable right now. This concept sounds highly technical, but it is actually very simple when you look at corporate valuations. Consider a mature, established business like Coca-Cola. They have spent over a century building their supply chains. They operate in virtually every country, and they generate highly predictable profits year after year like clockwork. Because their business model is fully mature, Nobody expects Coca-Cola to suddenly multiply its earnings by 10 times next year. Therefore, its stock price is tied directly to its present-day cash flows. Now look closely at a hyper-growth stock like Tesla. Tesla trades at a massive premium with a total valuation that swings past $1 trillion. Yet its current net income is significantly less than what traditional financial models would require for an industrial company of that size. Why do investors willingly pay that premium? Because they are not buying the profits of today. They are buying the massive, theoretical cash flows that the company might generate 10 or 15 years from now through autonomous robotics and software ecosystems. Every major tech monopoly dominating the market right now is priced using these exact long-term assumptions, but a sharp shift in basic macroeconomics is making those distant future earnings worth significantly less today. The headline Consumer Price Index for May just accelerated to 4.2% year-over-year. This marks the highest inflation reading our economy has experienced in 3 years. To an investor, inflation acts like a mathematical gravity machine. If a company promises to generate $1 of profit 10 years from now, that future dollar becomes less valuable today when consumer prices are rapidly rising. Because high inflation erodes the future purchasing power of a dollar, institutional models must heavily discount future growth earnings. It is an automatic mathematical markdown. The moment inflation numbers move up, the fair value of a long-term growth stock automatically steps down. Now let us examine the global catalyst that is driving this inflation spike in the first place. Level 4 is the war that is costing you at the pump. The underlying fuel forcing inflation higher traces back to escalating geopolitical conflict. Military engagement in the Middle East has directly disrupted global energy shipping corridors. The physical geography of the region contains a narrow point of ocean known as the Strait of Hormuz. This shipping lane is only about 20 miles wide, yet roughly 1/5 of the world's entire oil supply passes through it every single day. Because of ongoing blockades and military friction, commercial tanker traffic has faced massive delays and forced rerouting. When global energy logistics are constrained, the immediate supply of crude oil drops, forcing international prices to spike toward crisis levels. These are not abstract financial metrics. You are seeing this reality play out directly in your daily cost of living. According to the official Bureau of Labor Statistics report, the energy index surged 23.5% over the past 12 months. These spiking fuel costs ripple into the entire economic system like an invisible tax. It costs significantly more to run the transport trucks that deliver goods to retail stores. It costs more to run manufacturing machinery. And it costs more for consumers to pay their home electricity bills. This energy shock creates a direct problem for the stock market through the actions of the Federal Reserve. The central bank has one primary mandate when headline inflation accelerates, and that is to slow the economy down. The main mechanism they use to cool inflation is keeping interest rates elevated. Higher interest rates make corporate borrowing expensive, which deliberately slows down corporate expansion plans. This environment is highly complex because President Trump recently appointed Kevin Warsh as the new Federal Reserve chairman. While the administration consistently favors lower interest rates to stimulate business, Chairman Warsh steps into an economy with inflation resting at a 3-year high and energy inputs rising. The broader domestic labor market remains highly resilient, meaning the Fed has very little pressure to step in and cut rates. As a result, the institutional bond market is aggressively adjusting its expectations. Yields on long-term 30-year Treasury bonds have climbed significantly, as Wall Street prepares for interest rates to stay higher for longer. Elevated interest rates increase the cost of capital, which instantly punishes overvalued companies that rely on cheap credit to sustain their operations. This macro landscape is exactly how the market sets a trap for emotional, unprepared investors. Level 5 is the strategy that wins while everyone else panics. When these forces align, the standard psychological reaction for the average retail investor is pure panic. People log into their portfolios, see rows of flashing red numbers, and impulsively liquidate their assets at the absolute bottom of the cycle. They make major permanent financial decisions based on temporary emotional stress. But institutional wealth managers look at this exact volatility through a completely different lens. They understand that macroeconomic adjustments are not the destruction of wealth. They are the structural origin of it. Every single historical market correction, from the dot-com bust to the global financial crisis was entirely temporary and followed by a complete structural recovery. The investors who successfully build lasting wealth do not try to guess the exact day a market downturn will hit its bottom, because doing so is statistically impossible. Instead, they deploy a completely mechanical system known as dollar-cost averaging. The rules are incredibly simple. You establish an automated investment schedule on a fixed, reoccurring timeline, regardless of what the evening news headlines are screaming. Whether it is every week or every month, a set dollar amount flows automatically into low-cost, highly diversified index funds. When the market is trading at all-time highs, your fixed allocation naturally purchases fewer shares. But when the market faces a sharp correction, your automated contribution instantly purchases significantly more shares while they are heavily discounted on sale. Over a long timeline, this system completely removes human emotion from asset accumulation. You stop reacting to geopolitical news. You stop guessing interest rate decisions, and you focus entirely on accumulating high-quality assets at a lower average cost. Consider the data from previous economic shocks. The individuals who continuously maintained their automatic index allocations right through the height of market panics captured the entire upward trajectory of the subsequent economic recoveries. The market does not remain suppressed forever, but your window to accumulate structurally cheap assets is always finite. The most actionable step you can take right now is to remove human friction. Automate your baseline contributions, let time manage the asset compounding, and allow consistent execution to build your financial fortress, while the rest of the crowd reacts in fear. If this breakdown helped you make sense of the macro forces shaping the economy, please hit the like button and subscribe to the channel. We translate complex financial data into clear, actionable language every single week. To understand exactly how central banking policy impacts your purchasing power over the long run, click on the video linked right here on the screen. Stay disciplined, keep your execution mechanical, and I will see you in the very next episode.